If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Vietnam Economy Q2 Productive presents a dynamic portrait of sustained growth, diversified expansion, and supportive macro conditions across sectors. In the second quarter of 2025, Vietnam's GDP annual growth rate surged to 7.96% year-on-year, accelerating from 6.93% in Q1, and marking the strongest quarterly expansion since mid-2022. That performance builds on the full-year 2024 growth rate of 7.09%, reflecting robust momentum carried into 2025. The economy thus showcased strength in Q2 that underscores the productive characterization. Output gains broad-based, propelled by industry, trade, and domestic demand. Turning to labor markets, Vietnam's unemployment rate for Q2 2025 increased modestly to 2.24%, up from 2.20% in Q1. Though this marks a slight uptick, unemployment remains very low by international standards. The number of employed persons in Q2 rose to 52.0 million, up from 51.90 million in the prior quarter, while the number of unemployed persons fell to 1.06 million, down from 1.10 million. These figures reflect continued absorption of labor into expanding industries and services, reinforcing the productivity trend. On policy rates, Vietnam's benchmark interest rate is expected to remain at 4.50%, consistent through Q2, based on prevailing models. That rate, while moderate, supports credit expansion without unleashing inflation pressures. It anchors real rates in a supportive zone, enabling firms and households to access loans more affordably than in tightened environments, which helps sustain growth and capital investment at the margin. Inflation in Q2 also demonstrated manageable levels. In June 2025, the annual inflation rate registered 3.57%, rising from 3.24% earlier in the year. While that uptick signals some upward pressures, especially in food and energy, the rate remains moderate compared to historical extremes. Core inflation, which excludes volatile food and energy components, averaged near 19%, reflecting a degree of price stability in underlying demand. The inflation dynamics in Q2 balanced upward pressures with the cooling effects of monetary discipline and moderated external price transmission, supporting real income growth and demand. On the public finance side, Vietnam's government debt-to-GDP ratio remained relatively modest. In 2024, debt stood around 32% of GDP, and projections suggest a ratio near 32.0% by end 2025. That low debt burden gives Vietnam desirable fiscal headroom to support growth-enhancing policies, infrastructure investment, or targeted stimulus without undermining credibility or pushing debt unsustainably high. In sectoral decomposition, Q2 was marked by strong performance across industry, manufacturing, agro-based production, and public administration and services. Manufacturing growth exceeded 10% year-on-year, driven by electronics, garments, and machinery exports. The processing and manufacturing sector remained the leading contributor to growth, benefiting from global supply chain reorientation and favorable foreign direct investment flows. Agriculture recorded stable output gains as rural areas rebounded from earlier weather shocks, while public administration and services sectors expanded steadily, reflecting ongoing government operations and gradual recovery in transport, logistics, and domestic services. Gross fixed capital formation also picked up in Q2, with investment inflows driven by both domestic and foreign sources. Infrastructure projects, especially in energy, logistics, and industrial parks, gained traction, supported by state and private partnerships. Export-oriented regions saw expanded factory capacity, reflecting investor confidence in Vietnam's policy consistency and export prospects. Trade performance remained a core pillar of productivity. Export growth was strong, led by electronics, mobile devices, and component parts shipments. Import volumes also rose, fueled by intermediate goods and capital equipment necessary for robust production expansion. The trade surplus remained positive as exports outpaced imports in value terms, contributing to net external demand. Remittances and tourism recovery added supplementary support to current account stability. Credit growth in the banking system moved in tandem with real activity. Lending to enterprises, particularly in industry and manufacturing, stayed robust, facilitated at moderate interest rates. Household credit, focused on housing and consumer durables, also expanded, though less aggressively than corporate borrowing. The flow of capital into productive sectors reinforced capacity expansions, while credit standards remained prudent to guard against balance sheet risks. Consumer demand contributed amidst rising confidence. With inflation fairly controlled and employment stable, household spending on consumer goods, services, and durable items expanded. Rural incomes improved on agricultural gains, and urban consumption responded to wage growth in industry and public sectors. Retail and wholesale trade picked up in metropolitan areas, supporting domestic demand even as exports remained a growth anchor. Notably, risks from external conditions and policy shifts loomed, but Vietnam navigated them with resilience. Global demand softness, tariff pressures, or supply chain disruptions could dampen export momentum. Yet Q2 productivity gains showed that the domestic engine retained strength. The government and central bank managed credit conditions, exchange rate stability, and macro policy coordination to fend off external volatility. The macro balance in Q2 thus reflected a growth-friendly stance without ignoring stability. The real economy benefited from favorable global demand, competitive exports, moderate inflation, supportive but not overheated credit, and modest public debt. That combination allowed Vietnam to deliver strong Q2 output while maintaining the foundations for sustainable expansion. Summarizing the key indicators for Q2 in the productive narrative, GDP annual growth accelerated to 7.96%. The unemployment rate was 2.24%. The interest rate held at 4.50%. Inflation stood at 3.57%. Core inflation shot 2.19%. And debt to GDP remained around 32%. These figures collectively support the conclusion that Q2 was a productive quarter, growth robust, labor markets tight, credit backed by moderate rates, inflation contained, and fiscal metrics manageable. While 2025 full-year growth may moderate from the Q2 pace, forecast project growth of about 6.5% to 6.8%, a slight deceleration but still strong relative to regional peers. That midpoint reflects external headwinds, but Q2 underlined Vietnam's capacity to generate productive momentum even under pressure. The challenge will be to sustain momentum through policy calibration, productivity upgrades, and continued structural reforms. In sum, Vietnam's Q2 performance exemplified productivity in motion, expansion anchored by manufacturing, investment, and trade, solid job creation and low unemployment, balanced monetary settings, manageable inflation, and a sustainable debt profile. That synergy enabled the economy to convert external demand into tangible domestic growth rather than just cyclical swings. Vietnam's trajectory through Q2 thus offers a model for how emerging economies can maintain productivity momentum when global conditions turn choppy, provided policy and structural fundamentals align. Title: Vietnam Economy. 2025, Q2 Productivity Driving Growth. Vietnam Economy. Q2 Productive presents a dynamic portrait of sustained growth, diversified expansion, and supportive macro conditions across sectors. In the second quarter of 2025, Vietnam's GDP annual growth rate surged to 7.96% year-on-year, accelerating from 6.93% in Q1 and marking the strongest quarterly expansion since mid-2022. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.